Well, in this chapter, we're going to talk about bond prices and yields. And for the casual studier of finance, I guess, corporate finance, most of this should be review. So we won't spend a lot of time, especially on some of the older materials, but we will take a little bit of a deeper stab into some of the more complex information about pricing itself. So we're going to talk about the securities of bonds. We'll talk a little bit about prices and how prices change. In the end, we will talk a little bit more about default and what impact that has on bond pricing. As you're probably familiar, bonds are obviously debt obligations. It's a contractual obligation that the issuers have to bondholders. Typically, the face value is $1,000. Typically, the coupon payment is paid semi-annually, and it is usually a fixed coupon rate. The contract that sets all of these rules in place is something called an indenture. It's kind of like the promissory note that you would sign for a loan. It outlines the rules that have to be followed. We have several kinds of debt. Primarily, what we're going to discuss here is Treasury debt, United States Treasury debt. And again, these are just bonds, especially if you want to refer to a note. A note is typically 1 to 10 years. Treasury bills are obviously less than a year, and bonds that have maturity of over 10 years are typically referred to as Treasury bonds. So we have Treasury bills, Treasury notes, Treasury bonds. $1,000 is the most common denomination. However, for some types of United States Treasury debt, you can get denominations as small as $100. United States savings bonds actually, I believe, can be as low as $25. There's different kinds of features, if you will, that we can get with corporate bonds. Callable bonds can be called back by the corporation. We'll talk a little bit about those yields and how you analyze the yield to call in a few moments. But the key aspect of callable bonds is the company can decide to do this. The bondholder has no control over this. So it is a feature that if you wanted to label it as a good or a bad feature, this is a feature that is not necessarily good for the bond investor. Therefore, the bond investor is going to get paid for buying a bond that has this, in quotes, bad feature. So the yields on callable bonds will typically be higher than a regular traditional corporate bond. Convertible bonds can be exchanged for shares of common stock. The person that decides this is the investor. And since this is to the investor's benefit, of course, the investor has to ultimately pay for this benefit, and they'll pay for this by receiving a lower yield compared to a regular corporate bond. Puttable bonds give the bondholders options to retire bonds or even extend bonds. They're a special kind of a bond. And there are some bonds that ultimately have what we refer to as floating rates. So they may have an adjustable coupon that's dependent upon some measure of interest in the economy. We will frequently talk about preferred stock, but not in the terms of equity. Most of the time when you think about preferred stock, we should be thinking of preferred stock in terms of debt. The payments are fixed. They're paid before common stocks are paid. Common stock dividends are paid. So they act much like fixed income. In fact, that's the way many corporations will treat a preferred stock issue. They'll issue $100 million, and then they'll buy back $10 million a year for 10 years and ultimately then retire the issue. So again, like equity, they have dividends. They don't have to make payments, so that doesn't mean bankruptcy if they avoid that, but there also is no tax break like for common dividends that they receive when they make payments of dividends. A little bit about international bonds. Of course, you know that there are really two types of international debt. International debt that is in a currency different from the United States, and currency or interest rates or bonds that have interest that is or currency that is outside of the United States. So a foreign bond is issued by a borrower from a country other than the one in which it's sold. So a euro dollar is issued by a foreign entity, right? And it's typically issued in United States dollars. Euro bonds are denominated in one currency, usually that of the issuer, but it's sold in other national markets. So if you wanted to buy, for instance, a samurai bond, is a bond that is going to be denominated in yen, Japanese yen, but it's actually going to be sold in our national market. So again, in the end, the question that we always want to ask is, who cares what currency it's in? The people who are issuing debt do not care what currency they issue the debt in, as long as they receive the money and can buy the things they want to buy. But the investors definitely care what kind of currency it's in. So they're going to look at currency as being another risk factor. There are also some other kinds of innovations in the marketplace. We'll talk a little bit later about asset-backed bonds. And there are also things referred to as indexed bonds. Index bonds are kind of like floating coupon bonds, except the coupon really doesn't change. What changes is the value of the principal, and the principal is going to change as inflation changes. So these index bonds we're talking about here are referred to as TIPS. They're Treasury bonds that are inflation protected. So as you see, when the bond is issued, it has a $1,000 par value, and it's a 4% coupon bond. So the first year, there's 2% inflation. So 2% inflation is going to change the par value. It's going to increase it by 2% to $1,020. And of course, the coupon is 4%, is based on the par value. So the par value now is $40.80. The next year it's 3%. So now we have 3% inflation. It's going to increase that to $1,050.60. Coupon obviously goes up, etc. So in the end, the installment, the payment at the end, will be equal to whatever the par value is that's inflated or deflated by inflation. That will be the final principal payment. So you see what happens with this particular bond is the bond holder is protected against inflation. So again, if that's a benefit to the investor, which it is, so now you don't have to worry about inflation risk, then obviously you're going to have to pay for that. And how you pay for that is you're going to get a lower rate of return, because you have to give in for this benefit. You have to pay for that in some way. So if we come back and think about how bonds are priced, we've seen this formula before. It's just the combination of an annuity of coupons plus the present value of a par value sometime in the future. Now this is somewhat more complicated because the return here is based on whether it's a semi-annual or an annual interest rate. We would have to adjust this for M, the compounding frequency. We'd have to adjust the T, of course, for compounding frequency. And of course, the coupon would be the coupon divided by 2. So if we look at this particular bond, we have a 30-year, 8% coupon bond. The market rate's 10%, and we have semi-annual coupon payments. So we're going to use what's referred to as the bond valuation and duration worksheet. The data goes in, $1,000, 8% is the coupon. If you note down here, we have compounding frequency, it's semi-annual. So the coupon per period is 4%. The required return is 10% per year, and it's a 30-year time to maturity. So this bond is going to be worth $810.71. So just to do our basic investment analysis, would you pay $800 to get this bond that's worth $810? Of course you would, because you get an extra $10. If you did purchase this bond at for $800, you would have a yield to maturity over the life of the bond of 10.14%, and of course your required return was only 10%. Now this yield to maturity assumes that you're going to hold this bond for all 30 years. So if you think of way prices change, right, or as values change, we notice here that this is interest rate along the horizontal axis, and value is on the vertical axis here. One of the things we can see that as interest rates go up, bond values go down. So prices and yields have an inverse relationship. The thing that's a little bit more complicated here is it's not a straight line relationship. The bond price curve is convex, right? It's got this curvilinear function to it. So what that means is the longer the maturity, the more sensitive the bond's prices is to changes in market interest rates. So longer bonds are going to be more sensitive to changes than what happens to prices and interest rates. Again, we talked about the yield to maturity, and of course it is just the formula that we have, and you just solve for R. So in this example, we have this 8% coupon bond. Again, I changed the price here. We're going to sell this bond, can be bought for $750. So plugging this value in here, sorry, this is not correct. Let me change this real quick. Oh, it's not letting me do this. This number here should not be 1276. It should be this 750. Solving for this value, 750 equaling this formula, solving for the R, we end up with a yield to maturity again of 10.826%. So I apologize for that being not the correct number in this slide. So what do we know about yield to maturity, right? Yield to maturity is the bond's internal rate of return. It's the interest rate that you get if you buy and hold till it is mature. It also is the interest rate that equates to the bond's payments to its price, right? So again, it is just an interest rate. It's a rate of return that you earn if you buy and hold. One of the assumptions is that all bond coupons can be reinvested at the yield to maturity. Now there is another yield called the current yield, and this is just the bond's annual coupon payment divided by the bond itself. So now we have some relationships. If a bond is selling over $1,000, we say it's a premium bond, and in that case, the coupon rate is generally going to be greater than the current yield, which is going to be greater than the yield to maturity. So if the coupon rate is greater than the return that you're going to earn on your investment, you would be willing to pay for that extra cash flow. You would pay a higher premium. Discount bonds, on the other hand, have typically lower coupon rates. And if the lower coupon rates, if they're lower than the yield to maturity that you're going to earn if you buy, Again, you're going to do that by ultimately having a lower price. The bond is going to sell for less than $1,000. So that's the end of this first video. It's fairly quick, but we'll delve into some more complicated information with the next video.